Welcome to This Explainer. Today, we're cracking open the Ultimate Investor's Toolkit, decoding the exact mathematical ratios that'll tell you if a stock is actually worth your hard-earned money. If you've ever stared at a company's financial statements and just felt completely overwhelmed by the sheer volume of numbers, you are definitely in the right place. We're going to cut right through the noise. Here's our agenda. We'll be decoding key investor ratios, calculating earnings per share, understanding the price-earnings ratio, figuring out dividend per share, and finally, using all of that to make smart investment decisions. So let's just jump right in.
Section 1. Decoding key investor ratios. Who are they actually for?
Well, the crucial thing to remember here is that these ratios, they're not for the company owners. They aren't for the directors. They're designed specifically for us, the investors. It's all about helping you decide if you should pour your cash into their shares. If the metrics look good, you might buy in. If they don't, you'll know to walk away before making a costly mistake. It's literally your financial compass.
Moving to Section 2. Calculating earnings per share. Is the company actually making money?
So the classic textbook formula for EPS is just net income divided by the number of shares. Sounds super simple, right? But what happens when a financial statement doesn't explicitly hand you those neat, tidy numbers on a silver platter? Yeah. As investors, we usually have to do a little bit of digging. Take a look at this. We kind of have to uncover the net income step by step. We start at the top with sales of 600,000 rupees. Subtracting the $350,000 cost of goods sold gives us a gross profit of $250,000. Finally, take away $150,000 in operating expenses and boom! That leaves us with exactly $100,000 in net income. We found our first hidden number. Okay, next up, we need to find the hidden number of shares. You won't always see number of shares just plainly listed out for you. Instead, you've got to look at the balance sheet. You take the total share capital, in this case 300,000 rupees, and you divide it by the 10 rupee original par value. That's essentially the baseline issue price of a single share. Do that simple math, and it reveals exactly 30,000 shares exist for this company. And here is the exciting mathematical payoff. Dividing our 100,000 net income by those 30,000 shares gives us a really solid 3.33 rupees earned per share. Now, keep in mind, this is the company's earnings on that share. It means for every single share that exists out there, the business itself is generating 3.33 rupees in profit. So let's see how this translates into actual real-world strategy. If we take our company, earning 3.33 per share, and put it up against a competitor earning 5, and maybe another one earning just 1, well, as an investor, you're naturally going to gravitate towards company B, right? I mean, why invest in a company making 1 rupee per share when you could buy into one making 5? For sure, investors are always on the hunt for a higher EPS. But hold on a second. Just because a company is earning 3.33 per share, we really have to stop and ask ourselves a totally critical question. Are we paying way too much to buy into that profit? Because yeah, a high EPS is great, but absolutely not if the entry ticket is completely overpriced. Which leads us perfectly into Section 3, understanding the price-earnings ratio. Let's find out if you're paying too much. The calculation here is pretty straightforward. It's the current market price per share divided by that earnings per share we just calculated. This ratio, it's going to tell us exactly how much capital we have to throw on the table today just to lay claim to 1 single rupee of the company's earnings. And here's where market dynamics really come into play. See, because the company is doing well and generating profit, demand is sky high. Everyone wants a piece of a winning business. And because of that frenzy, you can't just buy in for that original 10 rupees anymore. No way. The market price has actually shot up to 25 rupees per share today. So, if we take that new 25 rupee market price and divide it by our 3.33 EPS, we land at 7.5. That 7.5 is our price-earnings ratio, or PE. And this is a massive revelation. It literally means you are paying 7.5 times the current earnings just to own the stock. This right here brilliantly illustrates how we should be comparing investments. Think about it. In our company, you have to invest 7.5 rupees just to earn 1 rupee of profit. But a competitor might only require a 5 rupee investment to earn that exact same 1 rupee. So even if our company has a pretty decent EPS, the competitor is actually a much cheaper buy for the real value you're getting. All right, Section 4,
calculating dividend per share. What actually goes into my pocket?
To figure this one out, we just take the cash dividend declared by the company and divide it by the number of shares. But before we crunch those numbers, we need a quick reality check regarding that 100,000 rupee net income we calculated earlier. Because as an investor, you can't just walk in and demand the entire 100,000 rupee profit. I mean, if a company gives away all its profit, how is it ever going to expand or grow, right? The directors need to retain a good chunk of it. In this case, let's say they keep 70,000 rupees for company growth. That leaves a much smaller 30,000 rupee slice that gets declared as cash dividends for the shareholders to actually take home. So by dividing that 30,000 rupee dividend pool by our 30,000 total shares, we see that you, the investor, are left with exactly 1 rupee of actual tangible profit per share in your pocket right now. Kind of wild, right? The company earned 3.33, but your actual take-home cash is just 1 rupee.
Okay, Section 5, making smart investment decisions. Let's bring it all together. To summarize this whole diagnostic toolkit, EPS tells us that the company itself earns 3.33 per share, but the PE ratio warns us that we're paying a premium of 7.5 rupees for every single rupee of those earnings. And finally, the DPS reveals we only take home 1 rupee in cash today, while the rest fuels future growth. You really need all 3 of these pieces to see the whole puzzle. So, as you go out there to build your own stock portfolio, I'll leave you with this to ponder. Are you chasing that high EPS? Are you trying to avoid a high PE? Or are you demanding a high DPS? Which of these 3 metrics is going to be the ultimate deal breaker for your personal investment strategy? Thanks so much for tuning into this explainer, and happy investing.